And the Zimbabwe Annual Investment Conference currently taking place in South Africa, and the country is set to be well on its way to economic recovery, with the banking structures playing a pivotal role. I caught up with Nigel Chanakira, founder and director at AfriAsia Kingdom Financial Holdings, on the stability and liquidity right now in Zimbabwe's banking sector.
Zimbabwean banks are now targeting the new minimum capital requirements, capital adequacy of 100 million. Which is a tall order to ask for Zimbabwean banks, but we've already got a couple of banks that have breached that part, and then all the banks have announced plans to arrive at that $100 million. At present, the majority of the 25 odd institutions that we have already passed the first hurdle, which was 25 million, and we are looking at the second hurdle of 50 million.
Are you comfortable from Kingdom's stance right now that you'll get there?
Absolutely. We passed the first hurdle comfortably. We had AfriAsia come in as a banking group. It's the fastest growing Mauritian bank, and they came through as a partner. And clearly their draw card for them is they have the wherewithal to bring in other co-investors with themselves. But we don't rule out mergers and acquisitions in order to consolidate our position. And so our aim is to be around. We've been around for 19 years, and as a banking group, the intention is to carry on in one form or the other.
Under the Kingdom banner, or would you potentially be absorbed into a larger bank group?
Well, it depends. I mean, it's a value proposition always that we look for. We kept the title Kingdom Bank. It's a well-known bank, but our group company became AfriAsia Kingdom. And so we assumed a double-barreled name, so to speak. But it's the value proposition, and we've seen, the benefits of bringing in a new partner and having that situation.
Now, when it comes to enhancing liquidity, one of the initiatives has been the introduction of T-bills, and that, according to the Reserve Bank, hasn't gone according to plan. What are your thoughts on the mechanisms that have been put in place and why it hasn't been able to enhance liquidity as they had hoped?
Okay, I think firstly, government was hesitant to issue bills because they ran a balanced budget. And so treasury bills were introduced as a short-term mechanism, to allow the flows of liquidity to, balance out with the liquidity flows in the market. And then I think there was a bit of an unfortunate development in that the tender wasn't deemed a free tender. And bankers tend to take interest rate views. And so the bids did go in, but they went in rather high. And the Minister BT has been very, conscious of managing the costs of funds. And of course, you've got the dilemma of idle funds sitting in banks, particularly the international banks, where depositors take greater comfort. And then we don't have a bank, central bank, playing the role of, lender of last resort. And so those two factors have really, jaundiced the market's development. We had a very, very active treasury bill market, one of the most robust in Africa about a decade ago. And so it's that confidence of those two pillars of allowing the central bank to buy and sell once it is capitalized itself, and then, of course, allowing the tender to go in line with liquidity flows. And so I think those two factors, once rectified, will see a very vibrant, trading market once again.
What do you see as the catalyst then for the revival of the banking sector efficiency, I suppose, if you could call it that, in Zimbabwe's economy? Money flowing into the banks and on towards the economy to promote growth.
A couple of things, Samantha. Banking supervision, which has increased, will engender confidence. The confidence did dwindle when you had collapsing banks in Zimbabwe. So we had, quite spectacular collapses. Once 10 banks collapsed, that led people to keep their money at home. We also had hyperinflation, and that didn't augur pretty well for savers. Whereas now we have an inflation rate of about 4%. We have interest rates that are double digit, which allows a handsome return. And what we're seeing just as a bank is the partnership with AfriAsia has allowed inflows to arbitrage those high rates. I mean, in US dollar terms, if you can get a return of 11%, that's very attractive.
Where are the flows coming from?
The flows are largely Chinese flows, Indian, coming through the gateway of Mauritius. We've also had South Africans now begin to show interest because the pension funds are allowed to do cross-border investments. I think 10% of their portfolio investments can actually flow, into other markets. So primarily their focus was on equity markets. We've got a market capitalization of about 3.4 billion and one of the better performing, markets in the world. And so they've directed, the investments to equities. But what we would need to do is develop an active bond market where government or municipalities begin to issue bonds with the capacity of actually retiring those bonds upon maturity.
Now, one of the hats you're also wearing is as the new chairperson of the Zimbabwe Investment Authority. What type of engagement have you had with investors so far, and what would be the strategic focus and the strategic plan that you hope to implement for the authority going forward?
I think, thank you, Samantha. I think it's been a breath of fresh air to have a new board active. We are a fairly young and vibrant board. We just had strategy meetings. The minister gave us a 12-point plan of things that he would want executed, and that's general efficiency of how that office is run for the benefit of investors. And quite clearly, we would want the execution of projects. I mean, last year, for example, we had over $400 million worth of investments applied for, and about 125 were actually implemented. Cumulatively, since the US dollar era, we've had investment applications for up to $10 billion. But probably, just $1 billion or $2 billion have actually been executed. So our perspective has been the uncertainty on policies, and so we will move in the direction of clarifying matters on the indigenization policy, which has been packaged very badly. As you well know, in countries like South Africa, there are empowerment laws. In countries like Canada, in Australia, all these sectors have certain restrictions on ownership. Mm-hmm. But on our part, we are in dire need for investments, and negotiations and waivers are possible, particularly in the infrastructure sector. And so we are looking forward to welcoming investors from all over the world, and specifically from South Africa, given the investment conference that we are having here in Johannesburg.